First, Porsche came out with some breaking news in the last 45 minutes, and the car manufacturer that last week agreed to be taken over by Volkswagen is now forecasting a full-year pre-tax loss of as much as 5 billion euros. Now, this would mainly be because of a charge linked to options that can be converted into Volkswagen shares. Porsche is still in talks with possible investors, but it did say that it's in talks, for example, with the Gulf state of Qatar. That's one of the parties interested. Now, on that news, shares initially dropped, but they're now gaining some 1.2%. Well, staying with cars, and Peugeot Citroën has reported a more than $1.3 billion loss, but it has managed to generate cash because of all the cutbacks it is making. The company is prepared for a tough year, though.
We have maintained our guidance for the whole year at 1 to 2 billion euros. Which seems a broad guideline, but we still have uncertainties on the prices and uncertainties on the supply side. I think the good news is that the free cash flow has been significantly positive. Unfortunately, we will not reproduce the situation in the second half, so our free cash flow for the year should be negative.
Now, Peugeot is not stealing all the headlines. Daimler's got its eyes on a gradual improvement despite more bad earnings, as Ryan Chilcutt reports.
Let's talk about Daimler. The company behind Mercedes-Benz posted its third straight quarterly loss today, dropping a little over €1 billion yet again. One of the reasons it's not getting the same boost to demand as other European car makers that have benefited from cash for clunkers programs because, of course, when you churn in your clunker, you probably won't have enough cash left over to buy a Benz. That's forcing Daimler to trim production so it can clear those lots of unsold cars. But, and this is an important but, it didn't lose as much as investors thought it would, and that has sent the shares up. One consolation for the luxury car giant, at least it is free of its very damaging partnership with Chrysler. Chrysler, incidentally, is holding its first board meeting today with its new boss, Fiat's chief executive, Sergio Marchionne. Makes you think of Daimler's chairman, who was behind the last tie-up with Chrysler and got pushed out as a result of it. Marchionne, though, thinks he can do better. We shall see.
Well, there's no waiting around for the drug industry to pick up. Earnings have beaten estimates for Sanofi Aventis, France's biggest drug maker. Its profit is up almost 29% thanks to diabetes drug Lantus and some acquisitions giving the company a strong 3 months.
It was a very strong quarter. That's clear. At constant exchange rates, which we believe represents more underlying performance, we clearly had strong growth of 17%. When you look at the first half, we're at 13%. Very strong performance of our core brands. Lantus up 26%, Lovenox up 13%, Plavix and Avapol at double-digit growth. So that gives us the confidence to say that we will do about 10% earnings per share growth at constant exchange rate.
And it wasn't as bad as we were expecting at Swedish company Assa Abloy either. The world's biggest lock maker had just a 2% drop in profit to $110 million. That's mostly down to some serious cost-cutting.
Our decline was slightly less than we had anticipated, so in fact we did a little bit better on that point, but where we really made a big difference was our savings program running into a very good result. So we both saw reductions on manufacturing footprint but also adjustment of capacity, which more or less matched the downturn.